In this session, let's look at mergers and acquisitions. Basically, the conceptual aspects. What are the different forms of mergers that are there? How would you classify the mergers on various grounds? So, the conceptual aspects of mergers and acquisitions. Along with that, I would like to also look at the valuation aspects behind the mergers. What are the different ways in which the target companies are evaluated or valued from a merger standpoint? Also, we would see how the benefits are basically distributed between the target company and an acquiring company. So basically all that preliminary concepts and the basic mathematical calculations behind the mergers and acquisition is what we would be looking at. Alright, so let's get started with this. Now, whenever we talk about a merger versus an acquisition, there is a difference between the two words. Whenever I am trying to acquire or purchase some portion of the company, not the entire company, whenever I am trying to purchase some portion of a company, could be like one business unit or probably one subsidiary of the company, not the whole company, one single branch. Whenever such kind of purchasings are happening, or some assets of some specified assets of the company, whenever such kind of things are being taken over, we call that as an acquisition. Whereas when the target is for the entire company, we call it as merger. Now, in this merger itself, we find quite a good number of classifications. So, based on the form of acquisition, we actually classify the mergers into three categories. One, a statutory merger, a subsidiary merger, and a consolidation. Let's say A and B. A and B have got into a statutory merger. Then, in this, let's say if A is the acquirer and B is the target. What generally happens in a statutory merger is B will stop existing as a legal entity. B will not exist as a legal entity. So all the assets and liabilities of B are transferred to A, and A will be the general, A will exist as it is. This is the case of a statutory merger. But in most of the cases, though, the target is smaller than the acquirer, in some cases we find target itself is bigger than the acquirer. Something like the case of a reverse merger. So basically in a regular merger, the target may be smaller compared to an acquirer, but in some cases we have seen the target is much bigger than the acquirer also. So, but the basic aspect in case of statutory merger is that target company will cease to exist, and it's only the acquiring company that would exist legally. Now, the next form, which is a subsidiary merger, is the same. If A and B have got into a subsidiary merger, then both of them, A and B, both of them exist. But B exists as a subsidiary of A, means the branding and everything of A, B will still remain. So B does not get out of the existence. It exists as a legal entity. Generally, this kind of thing is possible when you see that B has a very good brand image, it has a very good brand name, or it has a very good value among the customers, and A does not want to remove that and impact its profitability. In that case, we see that B will be becoming a subsidiary to A, and both the brands will exist, both the companies will exist as separate legal entities. That is what is the case in subsidiary merger. And so in this case, the major focus is B having a separate identity of its own in the market. Whereas in case of consolidations between A and B, both of them will not exist. Both of them combine together to form another legal entity called C, and that C would exist and not A and B anymore. Generally, this kind of a deal is possible between the companies of more or less equal size, like an Arcelor and a Mittal coming together. And so ArcelorMittal is the new formation wherein the individual companies have ceased to exist. So such kind of equal where the companies have equal weights, we see that generally a consolidation kind of a merger comes into picture. The other type of classification I look is by the type of merger, means what kind of companies are combining together, what kind of companies are coming together. So that can be classified as horizontal, especially if the merger is between two competing companies in the same industry. Probably Adidas taking over Reebok. Two companies in the same industry, right? Or HP taking over Compaq. So these kind of mergers, whatever it is, it could be a statutory or it could be a subsidiary or it may be a consolidation. I am not bothered about that when I am looking at it from the perspective of the type. So whenever the merger is between two competing firms in the same industry, primarily for the purpose of economies of scale, increasing the market power, or in some cases eliminating the duplicate resources, probably R&D team of this and the R&D team of this, both of them researching on the same aspect. But if they combine together, I can eliminate the duplicate resources and probably reduce my costs or increase my revenues, whatever it is. So the general motivation being the economies of scale or elimination of the duplicate resources, or probably even gain in the market share or create a kind of a monopoly in the market. So there are so many kind of motivations behind this, but typically the classification wise, whenever the two firms in the same industry are combining together, we call it as horizontal. Whenever the two firms that are combining are in the value chain or supply chain, probably A is acquiring B, where B is their major supplier of raw materials, or probably A is acquiring B, where B is the largest consumer of their products. So in such kind, we call the kind of merger between A and B as a vertical merger. The company which you are merging with, the company which you are acquiring, is somewhere in the supply chain or the value chain of the company, either up or down. When it is up, we call it as backward integration. When it is down, which is like a customers, we call it as forward integration. When it is with the suppliers, we call it as backward integration. When it is with the customers, we take it as a forward integration there. Then the other dimension which we look at is the conglomerate merger, wherein there is no relationship, they can be from any industry, they need not be competitors. You are just combining two companies in completely unrelated kind of industries. They are neither competitors nor as a part of the value chain. Any other companies you are trying to acquire, that goes as a conglomerate merger. probably the Sun Group acquiring SpiceJet Airlines. The Sun Group is more into an entertainment industry, whereas the SpiceJet is into airlines. May or may not have any kind of industry relationship. So when these two kind of firms merge together, it's an example of a conglomerate kind of a merger. So we need to really understand what kind of merger is happening, because that really helps us in assessing the synergies and in doing in actually understanding what could be the motivation for this kind of a merger. Now going further, we are looking at what could be the different kinds of synergies or motivations. I don't use the word synergy, but let me use the word motivation. What could be the prime motivation in terms of getting for a merger? So the most common motivation that is being talked about is synergy. Synergy is some benefit, and most of the time we see the benefit which would result in terms of revenue going up or the expenses coming down or both. So which means it's like saying revenues of A plus B together will be much more than revenues of A plus revenues of B. That excess is what is called as a synergy. Similarly, combined expenses of A plus B will be less than the expenses of A plus expenses of B separately, which means there could be some duplicate usage of resources, etc. So this is called as a cost reduction synergy. This is a revenue growth synergy, and in some cases I may get both of them. So whenever we are looking at such kind of scenarios, our intention is to find what is the value of this synergy. By how much extent the revenues of A plus B is greater than the revenue of A plus revenue of B. The same thing, by what extent the expense of A plus B is lesser than the expense of A plus expense of B. So the combined company is worth more than the parts as a part of synergy analysis. So a typical motivation in any M&A deal is the presence or perceived presence of synergies between the two. Apart from synergies, we would also look at a few more motivations in terms of the typical M&A deals. The growth. I want to grow faster, right? See, there is the possibility of growing organically, where I recruit more people, slowly I will grow. On the other side, I am growing at an exponential rate by acquiring other companies. So I will acquire or I will merge with some other successful company or some other company which could increase my market share very quickly without too much of learning curve involved, because the company is already present in the business for quite a few years. So through acquisition I can very well grow at a much faster rate. That could be one of the motivations behind the mergers and acquisition. There is a good side as well as a bad side. WorldCom as a company became a very good competitor to AT&T primarily through the motive of the mergers and acquisitions itself, where almost 60 odd acquisitions were done within a span of 7 years. But of course, that was also a sad story. This kind of overly emphasized acquisitions and now proper consolidations had resulted in a pathetic downfall for that company also. Though M&A can really help in dramatic growth within no time, if not done properly, it can have its own side effects. Then Mergers and acquisitions also provide for increase in the market share and market power. Probably you are consolidating the market. If there are 10 players, probably because of a few acquisitions you can reduce the number of players to 5, and at the same time your market share will increase drastically, which may result in monopolizing or duopolizing or oligopolizing the entire market. So your market power generally increases along with the market share when we are looking at M&A strategy. And sometimes I may observe in a target company some unique resources, right? They are specialized in some technology, or they are specialized in some core business operations, or in niche segment of marketing. I want to use their expertise, their resources to typically get a great value of my business. That's one of the things which Google has done towards YouTube. The acquisition of YouTube is primarily from that same standpoint, unique capabilities and resources of the target. So that could be a very good motivation for a merger. Then when we talk about diversification, okay, probably a Sun Group acquiring SpiceJet Airlines, probably there it could be treated as a diversification strategy because the company wants to spread itself into multiple businesses just to reduce the risk. But from an investor standpoint or from a shareholder standpoint, this is not a motivation that is perceived, because investor by himself, he could have diversified his risk by doing a very good portfolio management. So he does not want the company to get into a diversification process by acquiring some more companies and reduce the risk or so generally it is not considered as sensible from the perspective of the shareholders, but it is seen as a motivation factor for it is typically seen as a motivation factor for the companies, for the simple or for the management of the company, for the simple reason being their compensation may be linked very closely with the size of the company. And if you are growing through the acquisition process, it may so happen that your compensation is also increasing quite drastically. That is what could be one of the important motivation for the merger. Then this is another important aspect that we see. You can increase your EPS artificially without any kind of increased benefits, without any kind of additional value. You can look at increasing the EPS of the firm. That is what we call as a bootstrapping of the earnings. I'll just talk about this in the next slide by taking one example how I can increase the EPS of the firm artificially. That also, especially when I am having a very low EPS, I can think of increasing the EPS drastically by getting into a merger. And to make something more interesting, higher EPS is perceived as a bullish performance by the market. So even to create such a kind of impression among the investors, I would like to look at going for a merger. Then, as I have already talked about, the personal incentives of the management, where compensation is tightly linked with the size or probably positively correlated with the size of the company, even this M&A becomes a good motivation. And sometimes a very high profitable company means it ends up paying a high tax. But if it takes over a sick unit which is into losses, the combination will have a reduced tax impact. but at the same time it can use its expertise to turn around this particular firm and generate profits for the next period. So this kind of a strategy where you can merge or where you can take over a loss making unit to create a kind of tax benefit on the overall picture, and unlocking the hidden value of a struggling firm. A firm might have done really well in the past. It has some real good assets, but in the last few years it did not perform well, either because of no proper direction from the management, or probably it's not able to face the competition quite effectively, but it still has a lot of useful resources. In such kind of cases, we call those kind of or probably because of inability to market itself properly, it is not able to grow or create that kind of buzz in the market. So these are typically called as undervalued firms. So probably trying to unlock the hidden value of those kind of firms also, sometimes the mergers can happen. And there are so many cross border motivations also, especially taking over the firms abroad. So I can directly enter into the abroad market without getting into the adverse government policies. I can overcome all those government policies in the new country, and we can share the technologies. We can create product differentiation in that particular country. We can exploit the imperfections in the exchange rates or any other things across the countries. All these things become strong motivation, but of course you have to be vigilant that this can even increase the foreign exchange risk of the company also. So these are some of the key motivations behind the mergers and acquisitions activity. Now, okay, we were discussing about the EPS bootstrapping mechanism, wherein virtually I can increase the EPS. So in this case, what happens is a high P by E firm. The acquisition happens like this. A firm which is having a high P and P by E acquires a firm which is having low P by E, and this acquisition is only through stock swap. No cash transaction here, only through the stock swapping. Shares for one share of the target firm, some X number of shares of the acquiring firm will be given. So it is this transaction that gets into in case the EPS has to be virtually increased. So in this case, without any real economic gain or anything, you will see that the EPS will go up. Just let's look at this example and try to understand it. Company A has an EPS of 4. So earnings per share is 4 and market price is 90 per share. So market price is 90. So earnings per share is 4. Market price is 90. So what is its P by E? See, we generally see EPS into P by E is equal to market price. So we already know that the EPS is 4 into P by E, it is making it 90. So from here I know for this company the P by E is 22.5. Let's look at the other one, okay, and 500,000 shares. So what is the total worth of this company? Let's look at it. Okay, when it comes to B, it has an EPS of 2, market price of 25. So the P by E for B is 25 by 2, 12.5. So A has a very high P by E compared to B. Now let's say if A is acquiring B. So what is the total value of B? market price 25, and they are 500,000 shares. So the total market value of B is 125. So probably 12.5 million. 12.5 million is the total market value of B. So if at all I am giving the shares of A for that, I can give 125 12.5 million divided by 90 number of shares. Okay, so the number of shares that by taking all the shares of B, the number of shares of A that are typically given are 138,888. So the total number of shares now of A that are existing are 138,888 for the shares of B plus 500,000 shares of A. So these are the total number of shares of A that are present. Right? These are the total number of shares. Then what about the earnings? The earnings of the first company A, EPS is 4 and number of shares is 500,000. So 2 million is the EPS of earnings of A, because per share the earning is 4 and there are 500,000 such shares. So the net is 2 million is the earning of A, whereas 1 million is the earning of B. So the total earning is 3 million. So total earnings are 3 million divided by number of shares are 638,000 now, resulting in an EPS of 4.7, and none of the two companies have an EPS of more than 4, but the combined firm without any kind of synergy, anything existing, the EPS has gone up to 4.7. This is what is called as the bootstrapping of EPS. So for that to occur, I need to always see that a high PE firm acquires a low PE firm in a stock swap transaction only, because the total earnings anyhow will not change, but the number of shares outstanding, if I add these two, it is almost 1 million. But when I have got into this transaction, this is only resulted in 638,000 shares only. So the number of shares have gone down, but the typical earnings did not go down, which is where in the EPS denominator has gone down, resulted in a high EPS. So whenever we see a high P by E company acquiring a low P by E company, so high P by E is generally treated as overvalued kind of company versus low P by E treated as undervalued. Just by taking over the two, you can virtually increase the EPS also. That is what is being highlighted through this bootstrapping mechanism. All right. Then the other dimension that we are now looking at is what kind of merger motivations typically exist based on the life cycle of the companies. If we typically see the industry life cycle formed like the pioneering stage, the regular normal industry life cycle, when you are in the evolution or a pioneering phase, a rapid growth phase, a mature growth or shakeout kind of a phase, the stabilization or maturity kind of a phase, and a decline phase. So whenever the companies are at each of these layers in the industry life cycle, there are different motivations. Here the companies require heavy cash, right? Or probably there's a new business idea, so they want to see someone want to really invest in this particular business idea or use the talent of these companies for their growth. All these are the typical motivations. Generally, you see smaller firms look out for larger firms for providing capital, as well as whichever companies are ready to use the smaller firms' expertise. These are the common motivations. So that's where you see conglomerate as well as horizontal mergers at this stage. But when it comes to rapid growth, at least the company got slightly established, the product got accepted in the market. So now the next stage is expansion. So at this stage, companies have a real big problem in terms of raising capital for expansion purposes. So they look out for some firms who are capital rich, who can really fund such kind of growth companies. So because they require lot of access to capital, any company which is willing to supply more and more capital for these kind of companies, they could then these small companies can typically surrender themselves to the bigger ones. So conglomerate and horizontal mergers are possible in this case. But when it comes to mature growth phase, more or less the operations are consolidated. The companies, the rapid growth will not be there. Though the growth is there, it would be a normal growth. So in those cases, the focus is on consolidations and economies of scale, right? The competition will still exist. Not everyone is wiped off, but the competition is still existing. So though the growth has come down, but it is still occurring. So what is required at this stage is efficiency in the operations, reductions in the costs, economies of scale. So this is where the synergy based mergers are more and more focused. So that's where you see horizontal and vertical mergers happening more during this stage of the industry life cycle. Coming on to this stabilization phase, yes, the competition has come up too much. The growth potentials are very normal, but economies of scale is very important, because only when you cut down your costs, only then the survivals become more and more possible. So management thinking has to become more and more dynamic. So from that standpoint, the horizontal mergers in terms of consolidation, improving the market position, improving the market share become the major motivations at this stage of life cycle. Whereas when you come to the decline phase, the companies are looking forward for entering into new opportunities, new business lines. So any kind of a merger is literally possible at this stage. So these are some of this is the way we can actually link the motivations of mergers with the stage of life cycle. Then the other classification which is generally seen with respect to mergers is based on the form of acquisition. There could be a stock purchase or asset purchase. In case of stock purchase, it is like this: the shareholders of the target, let's say this is the company which is getting acquired. For this company which is getting acquired, there is an equity and there is a debt, which are balancing with the assets of the company. Now this entire equity is purchased by the acquiring company. So the shareholders of the target, they are paid either cash or the shares of the acquiring company. So the payment does not happen to the company here. The payment happens to the equity shareholders. So shareholders and the acquirer negotiate directly. So that's the reason we say that the shareholders need to approve the transaction, And in some of the cases, you could see it not even a majority, it could go into a super majority, like 2/3 of the shareholders, or 3/4, which is 75% of the shareholders, or 80% of the shareholders need to approve the transaction. So this could be the scenario of stock purchase. So especially in hostile takeovers, where the management of the target is not willing to surrender itself, where the management of the target is not willing to sell off, is not ready to agree for the merger, you will find these kind of stock purchase transactions wherein the acquirer directly comes in contact with the shareholders of the company. But here the problem is, because shareholders are getting the gains and not the company, corporate tax is not applicable here, but the shareholders have to bear any kind of capital gain that they are getting in the form of income tax. So the shareholders are bearing most of the tax related thing in this transaction, whereas in this case the acquirer will get the complete assets as well as liabilities of the target. Assets as well as liabilities of the target are typically assumed by the acquirer, because he is only purchasing only this portion. So for this portion he will get only the difference between the assets as well as the liabilities. So he has to purchase both the assets as well as liabilities of the company, right? But when we look at an asset purchase, the acquirer is actually purchasing the assets of the company. The acquirer is purchasing the assets of the company, where the payment is happening directly to the company and not to the equity investors. So from that standpoint, the company is liable to pay a corporate tax, but the shareholders have no responsibility with respect to the tax payments. Whereas in general, in this kind of a purchase, unless the purchase is for more than 50% of the assets, or the stake is going more and more higher, only then the shareholders approval is needed. But in regular circumstances, the shareholders approval is nowhere needed in an asset purchase transaction. Next, the other classification that we look at is based on the mode of payment, wherein we can talk about cash based payment or cash offering versus a stock offering. In a cash offering, the entire cash, the target companies, either shareholders or the company. In case of stock purchase, it is the shareholders. In case of asset purchase, it's the company. In either of the cases, especially when the cash offering is done, the acquiring company pays the target the shares, the cash, in terms of cash itself, for the exchange of shares of the target company. So in this case, what happens? Acquirer, because he is paying in cash to the target shareholders have no risk in the process. So the acquirer is assuming the complete risk and rewards of all the synergies. So even if the synergy works out, don't work out, the entire risk is borne by the acquiring company itself. But when we talk about the stock based offering, it is an exchange of stock. For one share of the target company, some X shares of the acquiring company will be given. So that ratio is what we call as exchange ratio. So in this case, whatever are the risks and the rewards of any synergy that is going to be present, that is shared between the target shareholders as well as the acquirer shareholders, because the share value can either go up or go down, and it will have an impact on both the parties, because we are seeing that the shares are exchanged and both the parties are having in terms of shares itself. So if it goes up, both of them are benefited. If it goes down, both of them are losing. So the risk gets distributed differently. Though the value is the same at the time of takeover, the risk could be different in both the kinds of transactions. and even the way the valuation of the companies happens also is different for this different kinds of transactions, and this can have an impact on the capital structure also, because if the stock offering is being done, it may so result that the number of shares are going up, whereas if the cash offering is done, probably the cash assets, the current assets, the cash of the company is going down. And if at all a huge debt is raised for a cash purchase, it can even increase the debt of the company, so which could create a financial leverage increase, which could result in the ratings of the company going down, especially for a cash purchase. Whereas when we are doing for a stock purchase, the ownership's stake is diluted now because more number of shares are created. So the stake of the ownership is diluted, and it can pose a big threat for a potential takeover also. So we have to really evaluate the positives and negatives of both these kind of offerings before actually getting forward into the merger process. Then the other classification, which is primarily looked at from the perspective of the management of the target, we see that the merger could be classified either as a friendly merger or a hostile merger. Whenever we talk about friendly merger, it's a kind of agreement or approval between the management of both the companies. They sit together, draft a kind of an agreement before they share everything with the shareholders of the target. So it is done on mutually comfortable terms. The deal price and everything are done based on the mutually agreeable and comfortable kind of a term. Whereas whenever we talk about hostile, the management of the target, even the board of the target, they are not willing for a merger. So that's where we use the word as takeovers. Hostile mergers, generally we classify them as takeovers, and because the management is not willing to merge, the acquiring company, it directly approaches the shareholders through a process called as a tender offer, wherein it offers some kind of a premium to the shareholders of the target, asking them to surrender their shares, and when they surrender, this company will purchase all those shares at a premium from the public. That is what is the scenario of a tender offer. Or it can start a proxy battle wherein it can talk to the shareholders to replace the board with the people who are in favor of the merger. So probably the existing directors, the existing members of the board, it wants to be replaced so that the new people, they come in favor of the merger. So these are some of the things, especially when there is a hostile takeover, especially when the target's management is not willing for a takeover, they can get into all these kind of activities. Then, in case of hostile takeover, the management of the target, they don't want to surrender. So in that scenario, we have a few defense mechanisms. We classify them as pre-offer and post-offer. Before the offer is made by the acquirer, whatever are the ways in which the possibility of a merger can be stopped, we call them as pre-offer takeover defenses. And once the takeover offer is being made, what all are the various mechanisms which can be used by companies to prevent the takeover goes as a post-offer. Some of the interesting aspects as a part of each of them. As a list of pre-offer, we see what is called as a poison pill. Very interesting piece. So the target shareholders, the shareholders of the target, they are given some kind of a right. All the shareholders of the target company, they are given a right that they can purchase additional shares of the company at a price which is much below the current market price. So because of that, what could happen? Number of outstanding shares will go up. Because more shares are purchased, number of outstanding shares will typically go up. And because the number of outstanding shares are going up, it may result in the acquiring company, it is now forced to purchase more number of shares to get the ownership. So it becomes a heavy cost to the acquirer because of the dilution that is happening, because of more number of outstanding shares that got created. It costs heavily for the acquiring company, and it may back out of the takeover process. So this is what we call as a poison pill. Otherwise, we look at poison put, a slightly different proposition, wherein the option is provided to the bondholders, not the shareholders of the target. The option is provided to the bondholders, saying they can demand the immediate redemption of their bonds. So they want the entire debt to be paid off in case a hostile takeover is occurring. So immediately after the takeover, it becomes the responsibility of the acquirer to pay off the entire debt to the bondholders, which becomes a heavy cash flow issue for the acquirer, which will prevent the acquirer from moving further. That is what we call as a poison put. In some states, the takeover laws are very much favoring the target, not the acquirer. Means if at all the target is not interested in surrendering itself, the laws will prevent the acquirer from going further. So what the company can do is, it can re-register itself, reincorporate itself in those particular states where the takeover laws are more in favor of the target than the acquirer. So that way they can prevent the takeover. And in some cases, what we see is the companies will get into a staggered board election. Probably it's like it splits the entire, let's say it requires 12 members in the board. It says 4 of them are elected this year, 4 of them next year, and 4 of them the next year. So these, and all of them are elected for a 3-year period. These 4 will retire here, and another new 4 will be re-elected. So in this process, what happens is, if at all there is a proxy battle wherein the potential acquirer wants to replace the board with his own members, it will take at least 2 years of election, because in the first election at the most only 4 people can be brought in. So it may not come out into a majority. So to get the majority, there is a 2 years time frame, so within which this particular company can plan out some other activity in terms of preventing the acquisition process altogether. So staggered board elections can very much stop the acquisition activity. Or they also get into the restricted voting rights. Means if at all a particular company has taken more than, let's say, 10% stake, immediately the voting rights for this company will cease to exist. Means you can still hold 10% of the stake, but you don't have any hold on the operations of the company. You don't have any voting rights involving in the day-to-day performance of the company. You are an investor in the company and you don't have any other kind of voting rights. So that is what we are calling as restricted. so that a tender offer kind of thing does not come into picture, especially when there are restricted voting rights. So that is something that can be planned, or sometimes it could be said for such kind of deals like mergers or acquisition, it's not sufficient to just get the opinion of majority of shareholders, but it needs to be a super majority. Either a 2/3 of the majority of the shareholders need to approve, or 75% of the shareholders need to approve it. So that's a kind of a super majority that could be brought in. And another interesting aspect is the golden parachute. The company can give a lucrative cash payouts to the senior members. In case the takeover happens, then they can leave the company immediately. If they leave the company immediately after the takeover, they will be paid very heavily. That is what we call as a golden parachute. It can help in multiple dimensions. Probably all these senior people, they are compensated for leaving in case of takeover, and this will make them work harder to make sure that the takeover does not occur also. So, even from an acquirer standpoint, one, the senior managers of the company are leaving, and two, there is a huge cash outflow from the company after the takeover, which could make the takeover process, the synergies of the takeover least affected. So this may make the acquirer back out from this takeover transaction also. All these kind of things are considered as the pre-offer takeover defenses in the M&A world. The same way we will look at some of these post-offer takeover defenses, like after the offer is being made for a takeover, what all can be done by the company which is not willing to surrender itself. One simple thing is just say no defense, means it can explain its shareholders why it is not showing interest in terms of the takeover, what is the intention in the minds of the acquirer, and how it does not benefit in any way to the shareholders. All such kind of explanation can be given to the shareholders, asking them not to surrender their shares or not to tender their shares, favoring for this takeover process. The second interesting thing which the company can do is it can get into a litigation process, file a case against the acquiring company on some basis. It could be on antitrust grounds or any other kind of violation. File a case against the acquiring company. So the settlement process takes some time, and the court can give some kind of orders in terms of stopping the acquisition process. It can delay the process. In the meanwhile, this target company can really look out for some other mechanisms to protect itself. So litigation is a temporary way of stopping the acquisition process to move further. Then there is an interesting thing called green mail, where you can have an agreement with the acquiring company itself saying it can repurchase its shares from the acquirer at a premium to the market value, and the acquirer does not make any other further takeover attempt. So it's a kind of a mailing or an agreement. It's probably a kind of payoff. It is generally treated as a payoff for preventing this takeover process, especially an offer given to the potential acquirer itself. Or sometimes the company can get into a share repurchase process where it can take a huge loan and it can repurchase its shares back. It may or may not take a loan. If it is taking a huge loan, we can even classify it as a leverage recapitalization. But if it is trying to purchase its own shares back from the cash flows that are available also, what is happening is whenever a share repurchase is done, the equity is going down, means the debt to equity ratio is actually going up. So for the acquirer, the debt to equity ratio will actually go up, which will have an impact on the ratings and all the other things of the acquirer. So it can make the acquirer back out of this transaction also. And in some cases, we see some interesting defense mechanisms called as a crown jewel defense mechanism, wherein I will carve out a small portion of the company and float this as a separate one, right? Carving out one portion of the company and floating it as a separate one, which could result after the takeover, it can get into such kind of a process that after the takeover, this portion of the company will be sold off either to someone else, just like an equity carve out. It can sell off the portion of the company to someone else, to some third party, and this is one of the key businesses of the company. In that case, what could happen? The potential acquirer may back out, saying that the key business of the company is lost. So if this is the key core business, by selling this to someone else, what is the point in acquiring this company? So that is how the post-offer takeover defense can come into picture. Then we are also talking about a Pac-Man defense. This is an interesting thing. If A has given an offer to take over B, the Pac-Man defense is nothing but B will place another offer to take over A. So it's like attacking from the behind. So B is placing another offer to acquire A. This can make A back out of the takeover transaction altogether. Or the general interesting aspects is get a white knight or a white square. White knight is probably sell off your entire company to some friendly third party. This is called as a white knight. I'll sell off all my assets to a company which is more friendly with me. When I am saying white square, I'll sell some stake of my company to a company which is more friendly with me. Let's say here the stake of the management here is 30%, the competitor is having 20%, and probably someone else, the regular shareholders, or they are having the remaining. So to make sure that this company does not get the majority, I must sell 10% of the stake to a friendly third party. So which means these two are an alliance now. Though it's not taking any control, it has increased the combined stake, which means if a competitor who is targeting a hostile takeover has to really get the majority, it becoming more and more difficult, because it has to cross the combination of these two. So that is where a white knight and a white square can really help in preventing a potential takeovers. So these are the various kind of games that are played either for getting into the takeover or preventing the takeover, before the merger, after the merger, before the proposition, after the proposition also, which can really result in the takeover processes being backed out also. Alright. Then the other mechanism that is being looked at is this takeover process resulting in any kind of antitrust laws coming into picture, which is more like, is there a possibility of monopolization that is coming in because of this takeover process? That is what is generally measured by Herfindahl index. And the way we measure the Herfindahl index is take all the firms in the industry, take their market shares, square them and add them. So if one company is having a market share of 10%, another 12%, another 3%, something like this, you square all of them and add them. Whatever is the number that comes, you see whether it is less than 1000, no problem. Means the industry is very well diversified. So many competitors are existing in the industry. There is no scope for any kind of collusive deals or any kind of monopolization in the process. So no antitrust rule will come into picture at all if the Herfindahl index after the merger is also less than 1000. But if it is lying somewhere between 1000 to 1800, still it may not be a big possibility for an antitrust law to come into picture. But before getting into that, one more verification is done saying that what is the pre-HHI versus post-HHI. Pre-takeover, what is the HHI, and post-takeover, what is the HHI. If the difference is more than 100, then there is a possibility of the antitrust law coming into picture. Whereas if the difference is less than 100 and the value is lying between 1000 to 1800, then also there is no question of concentration coming into the picture. So there is no question of any antitrust law or any monopolization related thing getting in. But anywhere you see that post merger the HHI is going more than 1800, there is a possibility of monopolization that is occurring, which could result in the merger process being halted on the antitrust grounds. So regulators can really intervene in that particular merger process in case the HHI is going to be much higher than 1800. Now let's see one small numerical to find out how do I look at the Herfindahl index. There are 12 firms in the industry. 10 of them have a market share of 7% each. 2 of them have a market share of 15% each. So overall 10 into 7 is 70 and 15 into 2 is 30. So what is the overall HHI there? So 7 squared. So 7 squared is 49 and this 49 is exhibited by 10 firms. So the overall HHI for those 10 firms is 490. And what about these 15? So there are 2 firms with 15, which means the HHI is, the square of the market share is 225 multiplied by 2 firms 450. So the total HHI before the merger was somewhere around 940. Now let's see if 2 of the 7% market share firms agree to merge. So let's say 2 of the 7% firm means there is a 14% share. So what is happening? 8 firms will still have a market share of 7% only. So 392. These 2 firms with 15% they will retain. But there is one firm which is with 14%. So the value is becoming 196, which is resulting in a summation of 1038. This difference is somewhere less than 100 itself, which may not result in any kind of antitrust issue. But on the same lines, you assume that the 2 15% firms are combining, not 7% firms. In the same example, if I assume that the 2 15% firms are really merging together, what could be the result? The 10 firms will be as it is, whereas that one firm will have 30% share. So overall, it is coming out that the summation is around 1390 from 940. So almost 400 or 450 changes there, This is in this scenario, the antitrust law can come into picture and may or may not approve this takeover process at all. So that's how we use the HHI index to really look at the acquisition from the perspective of monopolization, from the perspective of antitrust. All right. Now let's get into the calculation processes involved in valuing different kinds of mergers. Right, we talk about three different mechanisms of valuations. So here from here onwards, we will look at the various mechanisms that are available to value the merger transactions. All right, value the target, how much has to be paid for the acquisition of the target, and similar kind of calculations. So looking at the valuation process, we have three common forms of valuation. One is valuing from the fundamentals, which is called as discounted cash flow based valuation, wherein we will try to find out the free cash flow to the company, free cash flow to the firm, and discount that free cash flows to the present value by using a discounting factor based on the risk, and try to find out what is the value of the target firm. So basing on the synergies, okay, A and B have to get into the merger transaction. A wants to acquire B. So what can very well happen is, I can value B in isolation, finding out if at all the takeover was not happening, what could be the value of B. The same way I can value A. Now if A and B are combined, what could be the projected financial statements, the balance sheets, the P&L statement, the cash flow statement for this combined set of companies, so that and find the value of the combined firm. So value of the combined firm can subtract the value of the individual firms separately. So value of A plus B, from this I can subtract the value of A separately and value of B separately to understand the value of the synergies. So based on this synergies, an appropriate premium can be decided for the actual takeover transaction. But the way to arrive at that itself is, the first step requires developing the financial statements for the target company, projected financial statements for the target company, as well as for the combined company after the takeover, assuming whatever the synergies relating to the revenues growth, expenses decrease, or both. Figuring out all those kind of synergies, develop the pro forma financial statements for the combined firm, and in that, the way I can compute the free cash flow to the firm is, initially I start with the net income. To this net income, I add I into 1 minus T, which is the post-tax interest. This is what will become the unlevered net income, irrespective of the financing mechanism that is there. What is the net income for the business? That is what we are calling as unlevered net income. And to that unlevered net income, if I am adding the changes in the deferred taxes, because deferred taxes are more from the perspective of the differences between the financial reporting as well as the tax reporting frameworks. So whatever are the changes that have come because of those differences, we are adding to this unlevered net income to arrive at net operating profit net operating profit less adjusted taxes. And to whatever the no plat that is coming out, I add up the depreciation. No plat, I am adding up the non-tax expenses which are depreciation, subtracting the changes in the net working capital, and also the capital expenditure for that particular year. If I am subtracting, whatever I am left with is the free cash that is available with the company to distribute to its investors. It could be shareholders as well as lenders. So whatever is the cash that is available with the company, after deducting all the necessary expenses for the particular year, whatever is available with the company, that is what we are saying as the free cash flow. So for every year, based on the pro forma financial statements, we will find out the free cash flows. And of course, so we can even find out the terminal value, means forever, every year from probably the next 5 years pro forma financial statements, I can very well assume how the free cash flows are going to grow over the long period of time. So from where I can arrive at what is the perceived growth in the free cash flows year over year. So from there I can even arrive at the terminal value for this free cash flows and use any kind of simple discounting mechanism using an appropriate discount rate which reflects the risk of that particular firm. Use the appropriate discount rate and discount it back to the present value, and that is what we are calling as the free cash flow based valuation. Simple benefits wise, if we see, it is very comfortable in incorporating the synergies. So whenever a synergy changes at some point in time, it can very well be modeled. So because it's a financial model that incorporates how the benefits between the merger are getting reflected. So it is taking into consideration the synergies and the change in the synergies. So you can model them as a part of the spreadsheet model, and you can even change the forecasts based on the changing fundamental conditions which can change the value of the firm. So the customizations become more and more easy using this process. But of course, if the free cash flows are working out to be negative or something, we have some issues with respect to how they are growing, and so it becomes a very big difficulty in terms of using the formulas, especially when the free cash flows are going negative. The items which I am highlighting in red are the disadvantages associated, and there are so many assumptions that we are making, assuming that these are the synergies, assuming the revenues will grow at this rate. There are so many assumptions we are making in this process. So most good number of assumptions may be prone to an error, which means the calculations which we are doing, they are all prone to error. We are not we are not making our projections, our valuation based on the current values, but we are basing our valuation based on how we are perceiving the future growth of this particular combination, of this particular merger. What are the synergies that I am expecting in the future? So based on that, we are going ahead with the valuation process. So just let's look at one small numerical. So if at all I am having this particular data, how do I use it to compute the free cash flow? Net income. So as I have discussed in the concept earlier, to the net income I add I into 1 minus t. which is 2.34, which will make unlevered net income. So this is unlevered net income. To this I add the changes in the deferred tax, and whatever I get here, this becomes the NOPLAT, which is net operating profit less adjusted taxes, because I am adjusting the changes in the deferred tax. And to this I add back the depreciation and subtract the change in the working capital as well as change in expenditure, because if these are positive they will reduce my cash. Increase in working capital will decrease the cash, increase in current expenditure also will decrease the cash. So because of those two things, my cash position is actually getting decreased. So this will be decreased by the extent of some 5.55 million. So net is nothing but 5.08 million. So this 5.08 million will become my cash flows, free cash flow for this particular period. The same way I can compute my cash flows for each of the periods for the next few years. I'll make pro forma financial statements, arrive at these kind of calculations for each of these years, and based on that I will arrive at the free cash flows for each of the years. So assume that I have got these numbers as the free cash flows for the next 5 years, 17, 30, 50, 63, 73, and at the end of year 5 the value of the firm is taken as 272, which means the terminal value, sum of 6, 7, 8, 9, 10 years and infinite years cash flows, all of them discounted to the end of the 5th year. Let's say it has come out to some 272 million. So how much should I need to find as the value of the firm today? So what are the free cash flows as of today? 17 million, 30 million. This is 1 year from now, means in the next years I am expecting a 17 million free cash flow. In the year next to that I am expecting 30 million. Then I am expecting around 50 million. In the 4th year I am expecting around 63 million, and in the 5th year I am expecting around 73 million. And from 6, 7, 8, 9, 10 all discounted to this year, I am expecting that value is somewhere around 272 million. So probably I could have combined these two things, saying 345 million for the 5th as well as 6, 7, 8, 9 all put together. So based on this I can very well find out the NPV, which is what will give me the valuation part. The NPV under the rate of 7.6% and assuming these particular cash flows will tell me that the present value of the firm is somewhere around 368 million. So for an effective takeover, I will look at this value of the combined firm to be around 368, or probably the value of the target firm to be somewhere around 368 million, and based on that I'll start my negotiations process. So this is how I use the discounted cash flow valuation mechanism to find out what is the value of the merger transaction. Now the next mechanism that we are using to find out the value of the merger is using a comparable firm, right? Probably I'm not estimating any of the free cash flows or not preparing any of the futuristic financial statements or anything like that. I'm just looking at some comparables. In general, when we talk about comparables, we look at from the perspective of earnings per share, the book value per share, the cash flow per share, the sales per share, because all these will combine into ratios like P by E ratio, price to book value ratio, price to cash flow ratio, and price to sales ratio. These are all the typical comparables in terms of the stock valuation process. So I will look at these kind of ratios for the companies which are comparable to the target, means competitors of the target, and based on that information I will arrive at one price, and also I will incorporate the premiums that have happened in the recent transactions, and based on that I will arrive at one single price for my target firm, right? So here all the calculations are made based on the current data, assuming that the current data is a good reflection of the market price of all my competitors. Under such kind of assumptions, I am moving further in terms of valuing my target firm. So let's see, if at all the EPS of all the competitors is given something like this. The book value per share of the competitors, 1, 2, 3. I am taking 3 competitors of the target company, taking their book values per share, earnings per share, cash flow per share. I am looking at all those numbers, and also their current stock price. Finally, to come out to one mechanism of if at all this particular target firm has to be taken over today, what should be the appropriate price. If at all the target firm needs to be taken over today, what should be the target price. So from that standpoint, yeah, I have missed out something here. The stock price of this target firm is 68. Take this number also. The stock price of this target firm is 68. Now, using this information, how do I move further with respect to the takeover process? So let me just enter this data of all these companies, right? So company 1, company 2, company 3, and the target. I am looking at the EPS being 3.13, 1.1, 7.3 and 4.08. The book value becoming 14.14, 6.46, 28.48 and 18.87. The cash flow per share 2.41, 1.56, 5.45 and 4.22, and sales per share 24.02, 10.34, 49.79 and finally 40.26. And of course I am looking at current stock price. Current stock price 40, 20, 84, 68. Alright, whatever it is. Now all I am looking at is, now I have identified in this process. For me, the first step is identify whichever companies are the comparable companies. So probably the firms which are more or less in a similar kind of a business, similar kind of operations, if at all I am able to find, then I can directly take them as the comparable companies. And then now that I have a lot of information regarding their EPS and all those stuff, all I will do is I will get into the computation of the comparables. Generally comparables means either P by E, P by BV, price to book value, price to cash flow and price to sales. Okay, for each of the comparables I will do that process. Price to earnings. Okay, this is this much. Price to book value, price to book value is going to be this much. Price to cash flows is going to be this much, and price to sales is going to be this much. I can replicate the same for all my other competing companies. So price to earnings, price to book value, price to cash flows, and price to sales. Now that I have determined these kind of figures for each, I can actually arrive at, here the actual price of this is not that relevant for me. So for all these competing firms, what I'll do is, in the next step, I'll use some kind of a descriptive metrics which I can use for my target firm. The descriptive metrics probably could be the mean of these values, the median of these values, some such kind of number can very well be used. If I assume that I am going ahead with the mean, all I will be taking is the average of the 3 P by E's that I am getting. So the average whatever I am getting, I am taking, okay, 14.15 is the average P by E for this particular industry. Average P by BV is around 2.95. Average price to cash flow is somewhere around 14.94, and price to sales is somewhere around this. So what I'll do is, I'll take the numbers for the current company, and I'll take the numbers which are the price to earnings and all of the average. Based on this, I'll compute the various price possibilities of the target. So using the EPS, the expected price is some 57.75. Using the book value, the expected price of the target is 55.81. Using the cash flow per share, the expected price of the target is around 63, and using the sales per share, the expected price of the target is somewhere around 70. Whatever are the mechanisms that I am getting, probably on the various ways of computing the price, I can take the average price. So I can take the average price based on all these things. The average price is working out to some 61.89. And along with that, as a part of the next, so this is my base calculation, and on the top of that, I will bring in the takeover premium. I am seeing that the takeover premiums of the latest transactions, so this need not be for the same industry. Of course, if they are from the same industry, it's really good, but not a mandatory thing. So just to see in the recent past, what is the kind of premiums that the competitors, that the potential acquirers are generally paying to acquire the targets. So we are seeing that, okay, in one of the transactions the premium was 28.2%, 19.78%, 22.5% and 22.58%. So when I am doing the average, generally it has come to somewhere around 23 odd percent. Right, when I am taking the average, 23.26%. So from this, what I can do is, whatever is the value that this number has come out, I will increase this number by 23.26% and say that the appropriate value for this transaction using the comparable company analysis is somewhere around $76.29. So if at all this particular company needs to be acquired using the comparable firm analysis, I can pay around $76.29 to acquire it. Alright. Then let's see in this some of the key things to be looked at. When I am using a comparable firm analysis, see, whatever we have focused on, the EPS, book value per share, all these kind of numbers, they are easily available for all the comparable companies. Once I have decided which companies I will take as comparable companies, all these calculations of EPS, BVPS, all these numbers are directly available. So accessing the data is not a big issue at all. And the advantage is I am not doing any kind of forecasts of the future, which means there is no possibility of errors and all those things, because I am focusing purely on the current market data itself to arrive at the transaction price. But that itself could be a disadvantage, because I am going under the assumption that the valuation of all the competitors today is up to date. So that's one part. The second part is I am doing the, when I am computing the takeover premium, I am taking it, I am finding it out separately, because I am only looking at comparable companies which might not have undergone any takeover. So, and takeover premiums may be completely in unrelated kind of industries also. So there is no connectivity between these two. The companies which I am using for computing the price and the companies which I am using for computing the takeover premium, there is no joint, there is no linkage between these two firms. That's the reason probably the takeover premium which I am computing may be prone to some error. And these are all based on current market prices, which means the synergies or anything to do with the possible benefits or costs that can come up because of the takeover, nothing can be modeled. Only the current up-to-date stock prices and the few ratios, EPS, BVPS, few ratios are taken to finally arrive at the valuation price. So there could be a lot of ambiguity in that calculation, and whatever the historical data with respect to the recent takeover premiums and all may be changing on a continuous basis. Probably they could be lessons. So that lessons require some kind of, there must be some kind of overpricing in those transactions, and the companies may want to learn from them. So all these things, figuring all these things out as a part of the calculations cannot happen when I am using the comparable firm analysis. But on the other side, it is easy to calculate because all the data is readily available, and I am not doing any kind of estimations or projections about the performance of the combined firm in future. And the third set of valuation which we generally get into is the valuation using comparable transaction. Here we are not looking at comparable firms, but we are looking at comparable merger transactions. Means probably whatever are the recent merger transactions that have happened, preferably in the related industries itself. If at all there are any in the recent past, I am taking those transactions and from them trying to find out what should be the price for this particular merger. Here the only thing difference from the previous example is I am not focusing on the share price of those companies. I am looking at the deal price at which they were taken over. So because this is a transaction, the other comparables are more or less the same. So the process, to some extent, there is a repetition in the process, right? Identifying the companies or the transactions which are more similar to the current set of takeover, they have to be identified. And after that, all I would be doing is based on the acquired price, I will try to compute the ratios. So in this case, okay, I'll try to picture out. I have taken same numbers, but in addition, I am just putting deal price instead of the stock price. So the deal price, let's say it is 48.3 for this kind of company, 24.3 for this, and 104.4 for this. So what has typically happened is, based on this deal price, we are computing P by E, P by BV, P by S, and P by cash flow. Alright. So we are not going with the current stock price, but we are doing this with the current deal price, because it's a recent merger transaction. So this divided by EPS gives me P by E. This divided by BVPS giving the P by BV based on the deal price. This divided by cash flow per share, as well as this divided by sales per share. So these are the numbers, and for the other two comparable companies also I have arrived at such kind of numbers. Now all we are saying is, now that we have arrived at the P by E measures, the same thing, do some average or some other descriptive statistics on each of these measures. So probably let me take a simple average of each of these measures. So this is the average P by E, average P by BV, average P by cash flow, and something like that. And now that I know the targets, EPS and all, based on this I can directly find out what should be the deal price for, based on all these four approaches. Based on P by E multiplied by EPS, I say that the deal price should be somewhere around 70. Based on P by BV times the book value per share, I say it should be around 62. Based on cash flow per share multiplied by price to cash flow ratio, I say it should be somewhere around 77. And based on price to sales and multiplied by sales per share, I am saying somewhere around 86. And the same logic again, I can very well apply the average of these four mechanisms to typically say, using the comparable transaction analysis, I can say that the deal price for acquiring the target company in this case should be somewhere around 76 bucks. Right? So these are the three mechanisms that we are typically looking at for arriving at the price to value the target and go further into the transaction. So looking at even the benefits and disadvantages associated with this process, the advantage over the comparable companies analysis is, here I am not looking at the companies at all, I am directly taking the recently held transaction. So the price that I am looking at here is not the stock price but the real takeover price, which means there is no need to find out the takeover premium and all those aspects, no need to estimate that percentage, no need to segregate between companies for deciding the price and deciding the takeover premium. Both of them can still be one and the same, because all the transactions are taken, all the data is taken from the recently held transactions, but not the companies which have not gone into the merger process at all. But again, we are making an assumption that whatever the deals that have happened in the past, they are valued properly. If they are not valued properly, whatever is the mispricing that is there in those deals, we are carrying forward that kind of a mispricing into our current deals also. And just like the comparable companies analysis, we cannot incorporate the synergies or anything to do with the future growth or cost reduction kind of mechanisms for these companies. So this is purely based on the current price mechanism So we are not figuring out how the synergy will work in future. No such kind of modeling. So there is a disadvantage. We are just trying to compare some numbers, and based on those small simple comparisons we are trying to derive what should be the deal price for taking over this company. In general, these kind of processes will make sense for getting some quick ballpark figures, or if I cannot assess what could be the synergies that could be associated with the transaction. In those cases, I can very well depend on such kind of comparables based analysis. Okay, then the next important part that needs to be focused more on is, okay, some kind of a takeover has happened, purchase has happened, either through a cash settlement process, cash offering process, or a stock offering process. How do I compute what is the value of the firm after the merger? So value of the firm after the merger is value of the acquiring firm individually, value of the target firm individually, whatever is the value of the synergy that is being looked at, minus whatever is the cash that is being paid to the target shareholders. So that is what we call as the value of the combined entity after the merger. So out of that, this S is the value of the synergy. So whatever is the total price that has been paid minus the actual value of the target, so that is what we call as the benefit that the target shareholders are getting, and whatever is the difference between the synergy and the price that you have paid, the difference is what the benefit the acquirer shareholders are going to get. In most of the cases we see that the target shareholders get a good share of benefit, because it has been historically observed that in the long run the synergies whatever have been initially estimated, the companies are not able to meet that kind of expectation, resulting in failing. Most of the mergers are resulting in failing from that dimension, because there is an overemphasis on the synergies in terms of revenue growths or expense reductions, which may, but the target shareholders are paid immediately, which means they are not that much impacted because of the change in the expectations from whatever being projected as per the synergies. So here, depending on whether the company is getting into a cash based offering or stock based offering, what is the value of the merger, what is the value of the combined entity after the transaction, as well as what is the gain which the acquirer company is getting versus what is the gain that the target company is getting. We'll try to understand that. Okay, A is trying to acquire B. So the pre-merger stock price for A is $42.5, and there are 82.5 million shares that are outstanding. Okay, let me take the numbers a little bit more here. Okay, so A, as far as A is concerned, price is around $42.5 and number of shares is 82.5 million. So from here I can find out the market value of A before the merger. I am saying that the market value of A is somewhere around $3,500 million. So probably $3.5 billion. And when I come to B, I am looking at it as pre-merger stock price is $33 a share, and number of outstanding shares is 38.5 million. So from here I can find out that the market value of B before the merger, it is going to be around 1.27 billion, and I am expecting the synergies. So the value of synergies is planned at 127.2 million. Now I want to see which of these two. A cash offer of 12% above the current stock price is being made for the acquisition. So whatever is the cash offer, it is 12% above the stock price of B. So probably I can take it as 33 times 1.12. So close to 37 bucks, 36.96 bucks is offered as a cash price for acquisition. So what would be the acquisition price now? In this case, the acquisition value in terms of million could be 36.96 per share into 38.5 shares. So almost 1,422 million is paid in the form of cash. Now what is the total value of the combined firm now? We can decide the value of the combined firm. Value of market value of A, which is before the acquisition, value of B before the acquisition, value of synergy minus whatever is the cash offer that has been made. So the value of the combined firm after the acquisition is 3,480. Means actually A is losing because of this acquisition. Alright. So what is the gain to the target? This is where A is losing. But in the case, let's say someone has come out with a mechanism saying, probably if this was a printing mistake, that the value of the synergy is not 127.2 but it is 172.2. When I say it is 172.2, then the value of the combined firm is coming out to 3525. So which means the increase for A as a part of this transaction, their actual value is 3506, whereas after the acquisition they have gone to 3526, something like that. That's the value of the combined firm. So all I can look at is what is the value to the, or probably what is the gain to the target here. How much is the target firm gaining? Whatever is the price they have received, whatever is the cash they have received over the market value of them. So their value is only 1270, but they have received 1422. So their gain is to the extent of 152, whereas the gain to the acquirer, sometimes it can result in the loss also. When we had projected the value of the synergies differently, it has actually resulted in a loss to the acquirer also. In some cases, such a kind of deals are also possible. Okay, in this case, the gain to the acquirer is nothing but what is the increment to his value. So the combined firm minus the value of A in isolation, which is 19.74, is the gain to the shareholders of the acquirer in this kind of a strategy. Now, the second deal that is available is stock offer of 0.88 shares of A for each share of B. In fact, if you look at it, the cash offer of 36.96 is exactly same as a stock offer of, okay, cash offer of, let me just adjust it, 0.87, right? a cash offer of 36.96 is treated as 87, almost 87 percentage of the price. So let me correct this also. A stock offer of 0.87 shares of A for each share of B, which means both of them are more or less similar, right? As of now, if I see, okay, whether I purchase it at $36.96 a share of B, or I give 0.87 shares of A for each share of B. So here there is no cash exchange that is happening. So because of this, the total combined firm now, if at all it's a stock based, because there is no cash outflow that is happening, the value of the combined firm now will become value of A plus value of B plus the value of the synergies, but there is no cash outflow in this case. No cash is being paid to the shareholders of B. So the value of the combined firm will become almost 4.94 billion. It becomes a slightly higher value. Now, but what we have to look at is what is the gain that the target is getting. In this case, all I am seeing is how many shares are coming up to be. Initially there were 38.5 shares, 38.5 million shares of B existing. Now for each share of B, around 0.87 shares of A are being offered. So which means now after the offering, the total number of shares of A increased by around 33.48 million. Means the total number of shares that are available right now are 82.5 million of A and 33.48 million of B converted into A. So the total number of shares that are outstanding today is somewhere around 115.98 million. So per price, right, price per share now, going by the same logic, the combined value divided by the total number of outstanding shares is working out that per share the price is going to be somewhere around 42.67, and from this transaction per share it is 42.67. So I could look at what B is going to get in this 42.67 per share into 33.48 shares. So B is going to get 1428 million and A is going to get, this is price per share multiplied by this much. So A is going to get 3520 million, whereas B is going to get 1428 million. So based on this, I can say gain to the target is they are getting 14.28 million, but their value is 1270 million, means working out to 158 million, whereas gain to acquirer is resulting in whatever is the, they are getting 3520, whereas the market value for them in isolation is 3506. So their gain is only 14 million. So though the numbers are exactly the same, though the deal numbers are exactly the same, we will see that depending on a cash offer versus a stock offer, we'll see that the gain to the target as well as the gain to the acquirer will differ based on the mechanism that is being used for the takeover transaction. Alright. Now, whenever we look at a successful M&A deal, because I was just now mentioning that in most of the M&A deals, it so happens that the target benefits more compared to the acquirer. So the only cases where these kind of deals became very successful was in situations where acquirer was having a very good performance in the recent years. In those cases the deals were successful. Acquirer not overestimating the synergies and benefits, which is typically called as a management hubris. Acquirer is not overestimating the synergies and the benefits based on the target, and it is not getting into a very huge takeover premium. So that is also contributing to a good M&A deal. And the deals where more bidders are not there, because more and more bidders will result in more and more heavy premiums to be paid, which finally ends up as a winner's curse. I mean, though I am a winner, probably I am winning it at a very huge burden. So wherever the deals were there with very few number of bidders, they were becoming more and more successful. And at the same time, if the market is reacting very promisingly and profitably and positively to this particular transaction, this has become more and more effective and successful. And now the other side is we are not merging, but we are demerging, breaking off some portion of the company. So this is not a merging activity, but this is a demerging activity, typically for reduction in size. There are various mechanisms which help in that process. There is a divestiture, wherein this entire firm, it selects a portion of the firm, probably a business unit or one division. So this firm selects this small business unit and sells it off to some outside buyer. So it receives the cash, probably a cash infusion happens very easily. It receives the cash and gives the control to the other party. So one key business, probably which is not fitting into the long-term goal of the management, or probably which the entire firm is not able to manage properly, whatever may be the reason, some portion of the firm may be sold to an external entity, which is what we call as divestiture. But the same thing, if the same portion is created as a separate entity, right, and the shares of that entity are sold to the public through an IPO process. This is what we call as equity carve out. I am carving out a portion of the company as a separate legal entity, and the shares of it are offered to the public through an IPO process. So this company will have a separate management, no linking to this parent at all. But the same thing, okay, the same company is being carved out as a separate legal entity, but instead of offering the shares through an IPO, if the shares are proportionately allocated between these firms, so some shares of this parent are given to the same existing shareholders, the shares of this company are given in proportion to the holding of shares in this parent company. This is what is typically characterized as a spin-off kind of a transaction. Then one more situation that can come up is if the same separated legal entity, but the shareholders of this parent, they sell off the shares of the parent and buy the shares of the newly created entity. This is what will create a split off kind of a situation. So here the ownership in the parent company is lost to acquire the ownership in the newly formed company. This is what becomes the characteristic of a split off. And finally, one more way you can reduce the size is you sell off all the assets separately, especially in case of loss making or in case of bankruptcy. The assets of this combined firm are separated and they are sold separately to different entities, which is what is called as a liquidation process. So these are various mechanisms which companies can engage themselves into as a part of reducing their size and operations. And some of the reasons that are understood or that are really looked at is a business unit or a division, it's no longer fitting into the management strategy at all. So that portion of the business can be sold off, or the profitability is not that good for a particular business, probably because of a wrong choice or incapability of the management or for various reasons. So even that could contribute for the company to split off or spin off or carve out that particular business unit. Or we are talking about a reverse synergy scenario. Till now, when we talked about the synergy, the value of A plus B is greater than the value of A plus value of B. But when we talk about reverse synergy, it is the reverse. Value of A plus value of B in individual, as individual units, they are generating a much more value than as a combined unit. That is what is the situation of a reverse synergy. And especially one more reason that could be cited as a reason for divestiture is infusion of cash, especially if the firm is facing big financial difficulties. This process can readily bring up a quick infusion of cash into the system, and that can be used to pay off the debt or pay off the dividends or whatever it is. So from that standpoint also, the companies will look at a divesting kind of a process. So this is what in a nutshell we talk about the various elements associated with the mergers and acquisitions, the way you price the mergers and acquisitions, the way you evaluate the benefits to either of the parties in a merger and an acquisition, and even slightly about the reduction of the size through divestitures or carve-outs or spin-offs and split-offs. I hope this entire thing will give you a decent understanding about the basic conceptual and calculation based M&A process. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.